Well, we will now look at some of the recent market trends that have occurred and which can probably impact the actuarial valuations, particularly that we are now entering the valuation season a month from now. So if we look at the next slide, and we will see that the government bond yields across all the terms have actually fallen as compared to what they were as of March 2024. So the drop is largest at the shorter duration bonds, which is as big as 40 basis points. And the drop is comparatively much lower at the longer tenure bonds, which is say about a 30 or a 40-year bond. And it is visible that a drop is about 5 basis points for the longer duration bonds. Whereas if you also particularly look at a 10-year government bond, which is highly traded, and generally most of the organizations also have an average duration around that term. So the drop for a 10-year government bond is around 40 basis points. So what this means is that the bond yield reduction in bond yields is expected to create a rise in the actuarial liability. And the quantum of rise in the actuarial liability will primarily depend upon the liability duration of the individual schemes. Now, liability duration means that the average remaining working lifetime of the organization weighted by the liability, which also incorporates the actuarial assumption impacts, that is the attrition rate and the mortality rate. However, as we discussed a little while back around the risk management practices, we will observe that if the schemes have already adopted some kind of an asset liability matching investment strategy, the rise in the liability will also be offset against a similar rise in the market value of assets. Hence, the impact due to fall in interest rates may not actually hit the benefit schemes. Further, if the schemes have had a practice of adopting mutually compatible financial assumptions, that is ensuring a consistent movement between the discount rate and salary growth rate assumption, provided that the salary growth rate actually reflects the realistic picture, then such schemes may also not experience any major impact. Similarly, if we move on to the next slide, we will see the average salary growth rate and the average discount rate, which is adopted by the NSE 50 companies over the last 14 years. Interestingly, it's quite an interesting observation that the discount rate adopted was much higher compared with the salary growth rate almost a decade back. And this gap has narrowed down significantly in the recent years. In fact, the salary growth rate assumption is now comparatively higher than the average discount rate adopted, particularly in some of the recent years. Now, if we again move to the next slide, we will see how the salary growth rate assumption is what are the salary growth rate assumptions which are adopted by different companies across the entire NSE 50 as on 31st of March 2024. What we observe is that the average salary growth rate adopted by the IT and power sector was 6.5% per annum, whereas 8.9% per annum was the highest salary growth rate assumption which was adopted by the pharma sector companies. And for the rest of the sectors, the average salary growth rate assumption has been in a range of 7 to 8.5%. So this particular analysis and the research report is also available on the KPAC's Knowledge Center. In case if anybody wants to read this particular article and research report in depth, they can certainly access the Knowledge Center of the KPAC website. Also, it is important to understand that these are just the benchmarks, and these just reflect the trends adopted by the NSE 50 companies. These may or may not actually reflect the reality of the individual companies. So it is always advisable to collaborate with your actuaries while determining the salary growth rate assumption. So thank you so much everyone for attending this webinar. We are delighted to see the response and participation from everyone. Our endeavor is to organize more and more such webinars related to different areas of our expertise in future. So looking forward to everyone's participation in the future webinars also. So thank you so much, everyone, and have a wonderful evening ahead. Thank you. Thank you, Twinkle.
Thank you.
So the first question is, what is the impact in the profit and loss account and OCI by increase or decrease in the discount rate, salary growth rate, and attrition rate? The financial assumption and the actuarial liability will share an inverse relationship. So if the discount rate falls, the actuarial liability is expected to increase. Similarly, if the salary growth rate falls, the actuarial liability out here will also fall because the salary growth rate does not share any inverse relationship. However, if the salary growth rate and discount rate, they are both mutually compatible, which means that if the salary growth rate is falling, because the discount rate is also falling and by a similar quantum, then the impact of the change in assumption, particularly the financial assumptions, may not be may not be a significant number. Similarly, the possible impact due to change in the attrition rate. Well, attrition rate impact can, it's very difficult to theoretically answer whether the change in attrition rate can increase or decrease the liability, because the impact depends on a lot of other factors, and in particular the demographic of the organization. What particularly the attrition rate is at the moment, what is the average past service of the organization, the number of employees who have completed the vesting condition. So all of these conditions will have a cumulative impact on the liability if the attrition rate changes. So there cannot be a thumb rule around what the possible impact could be on the actuarial liability because of changes in the attrition rate. Whether we can maintain the same attrition rate for 3 years or every year, we have to change the attrition rate. Well, any actuarial assumption that we adopt are generally long-term assumptions. As long as you do not see any changes in the organization, or as long as you do not experience any random volatility in your employee movements and trends, it is not advisable to change the attrition rate year on year, because these assumptions are long-term assumptions and these should not be impacted by the trend which is observed just in a single year, because a single year can have some randomness and abnormal fluctuations also. So it is always advisable to keep the attrition rate unchanged as long as there is nothing abrupt or significant expected to happen in future. How many years exactly to be considered for gratuity payment? Well, for the purpose of calculating gratuity, the number of years must be, assuming that it is 2025 today and the employee joined on 2020. So we will have the precise date of joining and we will have the precise date when the employee is actually, say, retiring or leaving the organization. So difference, the number of years of the difference between the number of years between these two dates is the number of years for which the gratuity payment should be done. What if an organization 4 years and 240 days is considered as the tenure entitled for gratuity? Well, generally, if you observe that there are different organizations having say 5-day and a 6-day working condition. So for an organization which generally has a 5-day working condition, will have a 4 year and 190 days as the entitlement for the gratuity. and the other organizations will have 4 year and 240 days. But it is generally very common to see that if an employee has completed say 4 years and 6 months or 240 days, they are generally entitled with the gratuity payment. Although it is also advisable to speak on this particular aspect with the labor advisors. Why 15/26 is used? The number of months that are the number of days assumed in a month are 30. So the gratuity act says that the gratuity payment should be the equivalent to the half month's salary. So the numerator of 15 comes as a half month's salary. The denominator 26 assumes that there are 4 holidays in the month. So 30 minus 4 becomes 26, and hence 15/26. In role of stakeholders, when does the auditors come into picture? I think auditors play a very critical role at every stage, right from the data, assumptions, and validating the results. They play a very critical role in checking the data that is shared to the actuaries, in reviewing, in validating the assumptions with the management, because the auditors and the management have a greater insight into the management policies and the future trends of the organization, as well as validating the actuarial valuation results, which are submitted to the management. So they play an important role at each and every stage of the valuation process. Where would you show plan assets in company's balance sheet? Well, in terms of plan assets, you will always have the employee benefit plans will always have a separate gratuity, will have a separate trust which is created. Now, any asset which is a qualifying asset will only be considered as a part of the qualifying asset will only be considered as a part of the asset for the employee benefit plan. Now, in case if there are funds which are separately maintained, or a separate trust which is maintained for say a gratuity plan, then it will be reflected in the balance sheet of the trust, and correspondingly there will be a liability on the present value of obligation on the liability section of the trust as well as the company.